think two things that you always have to ask yourself when you incur any expenses and trying to put them on your tax return. You need to ask yourself, is this travel ordinary and is this travel necessary part of my business? Do I need to go to Asia to look for a property when I have no properties at all? I have no licensing and permit as a real estate professional to even start thinking about deducting travel expenses that abroad. But does it make sense for you to go that far and incur this much expenses?
Chang says, what are some other things I could write off my rental if I'm only writing off the minimum things such as depreciation, tax, and insurance?
Well, definitely think of it as a business, right? And there are some criteria whether you're actively participating in it or you're passively just renting property on the side, whereas you have a regular job, whether you're a real estate professional or real estate broker, those classification does treat your deductions differently. But as far as the items, when you think of a business, you think of anything that's ancillary to the business, right? You're talking about using your car to go to the rental property collect rent. And so some of this mileage are deductible. You're talking about advertising for your rental property, talking about, like you mentioned, insurance, repair, maintenance, I want to say HOA fee. You know, Trump is a real estate guy. So when he passed this law that we're under, it was very beneficial to real estate investments. And so there was really not a lot of cap. There's a limit to how you can deduct on your primary home, but very little limitations on deductions on the rental, except for the fact that if you are actively participating in it. As you mentioned, depreciation is a big part of the deduction on your property. 27 and a half years if it's residential and 39 years if it's commercial. But just because you bought some appliances or some fixed asset for your property doesn't mean that you can deduct everything one time, right? There is a depreciation schedule that you can use to deduct certain item 5 year, 10 year, 15 years. Some people even accelerate the deduction by using cost segregation. So there's so many strategies out there. But if you ask me what are the list of items, just you can even Google this. What are deductions? And you can see all the items and things that you have on there are the major ones already. Mortgage interest, there's some closing costs that could be added to the basis, so that increases your depreciation basis.
Appreciate the info. That's a lot of info that went over my head, so I'm glad you're here.
Yeah.
Trump saying he's taking income tax away and Kerry is going to support the government. Notice people going to hold out on filing their tax because of this. What's your thought?
To be honest with you, I'm a practitioner, so that means that I'm out there in the front line dealing with the IRS on a daily basis, representing taxpayer. And I literally had a meeting with the IRS 2 weeks ago on a mutual client, and again, they know the effect of the new administration with the whole cutting of the budget on federal programs and federal agencies like the FBI, the CIA, and even the IRS. But I don't think he ever mentioned anything about not collecting taxes or not having even the current tax code being eliminated. Tariffs gonna in somehow, some way generate revenue to pay for certain programs. It doesn't mean that it's gonna take over the tax revenue that they could normally collect from taxpayer. Again, this is one of those cases where you can actually say this is a hearsay or it's just too far-fetched. But everybody knows you're not gonna mess with the tax system. You're not gonna mess with tax collections and tax money. It's too entrenched in our system. Not just the fact that the revenue that it generates, but the people that are involved and connected to it.
And not just that too, but a lot of these clickbait news channels, they're trying to get clicks. So they're gonna give you like a good headline that is gonna make you want to click. And the president still has to go through Congress anyways.
I just want to clarify one thing real quick. If you are holding off on filing taxes for that reason, please don't do that. The deadline is still firm. We got the March 15 deadline for corporations, LLC, and S Corp. April 15 is the deadline for personal return. If you miss that date and you give the IRS an excuse like President Trump told me not to file taxes, it's not going to fly very well. So yeah, please don't do that.
James says, what kind of form or where do I add the expenses if I went out of town to see a potential rental property?
Well, it depends, Chad. If you are classified as a real estate professional and you have a rental already, then that's kind of justified for your travel. It's hard to say because it's kind of like a blanket statement that if you're just going out of town, that you're assuming that those expenses incur are tax deductible. I think two things that you always have to ask yourself when you incur any expenses and trying to put them on your tax return. Just to answer real quick, the form that you're talking about, if you have a property already and you are deducting it, it's Schedule E. You need to ask yourself, is this travel ordinary and is this travel necessary part of my business? Do I need to go to Asia to look for a property when I have no properties at all? I have no licensing and permit as a real estate professional to even start thinking about deducting travel expenses that abroad? Or do I go to Nevada and say, okay, I went to Nevada and incur this much expenses with a flight, travel, car, hotel to look for a property, for 7 days or something like that. You know what I mean? It has to be reasonable. Is it ordinary part of the business where I'm operating as a rental business capacity, whether you're a real estate professional professional or not, you can still operate as a rental business. But does it make sense for you to go that far and incur this much expenses? Now, for the most part, if you incur a couple hundred here and there, 1,000 there, and maybe you can explain, yes, I'm a professional, but no, I'm working towards it. IRS not going to worry about the minimal stuff. But if you're talking about thousands and thousands of dollars, just because you incur, you have expenses and receipts for it, doesn't mean that's ordinary or necessary part of the business. So that means they might not allow you to do that.
I have rentals and looking for another property soon. Lender want to see my income tax for 24. Should I take less deduction to get the deal and potentially have those extra 24 not taken this year to next year's deduction? Or maybe take the max deduction and pay less tax.
With anything, and again, I give advice, not that I know all the answers, but I help people think about the conflict of two priorities, right? There's always a give and take in most of the decisions we make. If it's always a win-win, then they wouldn't need people like me, or, life wouldn't be so complicated, right? So if you want to get that second property, then you're going to have to show more income, right? You got to show more capacity to be able to pay your debts and to qualify for the loan. So that means your taxes has to show some potentially profit in there. So if you max all your deduction, which means you pay less taxes, then the chance of getting a second loan will be very low. So you got to think, which is more important for you, right? What are your priorities? What's important? You can always get a second property. Maybe later when you have the capacity, meaning you have more income, more credit score, whatever it is that they're saying as a reason for you not to qualify. And even if you maximize your deductions on your tax return, who's to say that you're not qualified? I would say talk to people like Lisa first. Let them look at your tax return, look at your various income sources, the various assets that you have. Some of those have depreciation that are not always negative on your balance sheet, and that shows, more of a credit on your qualification for a loan. Other deductions are more detrimental. But I would say before you're assuming that, oh, should I take more deduction here or less or do this and that, talk to people like Lisa to see, let's look at your credit history. Let's look at your asset, the various assets that you have. Look at your income sources. Look at your taxable income, whether you're filing joint or by yourself. If you have a 1099 or W-2, if you need to show more income, you can actually alter your tax withholdings or contribute to your retirement more or less. It's complex, but I would say people like Lisa would definitely have a calculation or a formula to throw all that numbers in there and say, okay, this is what you need to do. Based on what you have, we might not be able to qualify for this loan, but there might be other loans. Or you might have to show your 2024 income tax return to have greater income. Maybe minimize some of your expenses, maybe depreciate it for a longer time so that you show more income for that year. Or maybe don't take too many deductions on your Schedule A or Schedule E because you need to show more profit or more, net income.
Any idea how to track and write off power expenses to charge my electric car at home? It's my business electric vehicle.
Let me try to explain. And when you mention electric, my mind just runs around in a circle because there's so many different people that use EV credits and people with homes that have a lot of electric power. They actually use that extra power as a business to sell to PG&E or to sell to other parties. And there are depreciation that you can take on those electric power grid or solar panels. Whether it's an electric car with power or a regular gas guzzler vehicle, you have to be able to differentiate the purpose of this vehicle. Within this vehicle, did you use it to show homes? I'm assuming that you're a real estate professional. If you have a business, do you use it toward buying equipment, tool and supply? Did you use it to go meet a client? Did you use it to go seminars and training? Whatever business activity you're using it for. So if you track those areas, let's just say that within that day, I drove and see my client or did this business activity, this many miles, then you can say within that many miles, this is how much electricity I use to power my car. That might not necessarily be a good deduction for you because that's the nature of EV cars. The cost of generating power for the car is not as high as the cost of gas, right? It's great, it's efficient. But if you're doing that, then why not use the other deduction, which is the actual mileage? That means that instead of actually deducting the actual cost of pumping gas, if you have a gas powered car, or in your case, electricity, how many miles did you drive to see your client? How many miles did you drive to do business activity, right? How many miles did you drive to go to seminars and training and buy supplies or whatever? So yes, there should be a contemporaneous tracking sheet that shows how many business miles you drive for the whole year. But normally what I do is I look at your odometer. I say within this window of time, January, December, you drove 20,000 miles. mile, and then your business activity is about 25% of that, then we rough estimate what those mileage would be. You want an actual expense. If you have the time for it, then you're gonna have to keep track. Point A to point B. I drove from my house in Elk Grove over to meet a client. That's 20 miles back and forth on this day, and we went over there to discuss, business activities or whatever it is. Some people would do that, but I think it's a little bit too much to ask a regular small business person to do. So I think the estimate mileage is a lot better. I've done, and I'm not bragging, but almost 100 audits, 20 years in business, and mileage and deductions on business has always been a topic that the IRS want to look at. But stay within the parameter. Know at least what your 1 year odometer look like, and don't claim the whole thing. Don't claim an 80 or 90% if your business activity is not up to 80 or 90%. The most you can try to do is maybe 30, 40, 50% at most, and the IRS is not going to mess with you on that. They're not going to expect every detail, but stay within the parameter.
How much money or cash can I give someone without being taxed? How do I declare this in my income tax return?
Very, very good question. I think people have this misconception that it's my family, it's my money. I give whoever and whatever amount I want. And there's IRS requirement, which is tax filing, and there's also bank requirements. If you go to the bank and you deposit 10,000 or withdraw 10,000 or more, they're gonna do a CTR, right? Cash transaction receipt. That doesn't mean what you're doing is wrong. It's just that they have a regulation that wants to know where this money came from. That's just part of the requirement to file those paperwork. Same thing with IRS. Basically, they're saying that if you give any of your family members over a certain dollar amount each year, you're required to report it. It doesn't mean it's taxable because there's two provisions. One is the annual exclusion, which is the 2025 year is 19,000. So from now in January to December 31st, I can give Chia 19,000, and it's always the donor, right? The person giving it, not the recipient, to file taxes. If it's 19 or under, Chia doesn't have to report taxes on that. And if my wife, like Chia as well, she gives him another 19,000, that's 38,000 he doesn't have to file. But if I happen to give him 20, I liked him this year and he looks like he can use an extra $1,000, then I'm required to file a tax return because I'm giving him more than the annual exclusion. The 19,000 is an annual exclusion. That means you don't have to file 19 or less. So since I'm giving him 20,000, that extra $1,000 is reported as gifting above the annual exclusion. Does that mean that me as a donor is going to pay taxes on that? Or does that mean Chia as a donee? No, neither, because there's a lifetime exclusion. That means that I can give my family member or anyone in my lifetime as long as it doesn't go over $13.9 million. Okay, and that number changes too. But man, I don't know about you, Chia. I don't think I have a lot of people that can give up to $13.9 million in a lifetime. So yes, I have to file the 709 tax form, which is a gift tax form, and yes, all this is saying that I give more than the annual exclusion of 19,000. So 1,000 goes against my credit, but I got about 13.8 million to go, right? So to your question, the donor has to file if they give more than 19,000 for this year in 2025 and 18,000 for 2024. But that extra dollar amount that you give is not taxable to the donor or the donee. It's just been put as a tracking system so that they know that you're not giving more than 13.9 million in your lifetime.
With that being said, I'm gonna let you guys all go. Thank you again for tuning in, and we will see you guys next time. All right, Chi Chi fans, peace out.